If you are thinking about buying a property in Spain and you are not a tax resident here, you have probably asked yourself these questions. What is better for me? Paying with my savings, applying for a mortgage in Spain, or arranging financing in my home country? And the truth is, there is not a single correct answer, because it depends a lot of your profile, how much money you have saved, your income, the country you come from, and also the purpose of the purchase. So in this video, I'm going to explain clearly the advantage and disadvantage of each option, and at the end I tell you which situations each one usually makes the most sense. Let's start with the simplest option, buying with your own money. At first glance, it may seem like the best option because you avoid interest, you do not depend on the bank, and the purchase process is usually much faster, and that has a real value. When you buy in cash, you are normally in a stronger position with the seller. You may be able to negotiate the price more efficiently, complete and purchase faster, and avoid the risk of the deal falling through because the bank does not approve the financing. For many non-residents, the option also brings peace of mind. They do not have to prepare as much documentation, they do not depend on Spanish lending criteria, and they avoid a good deal of bureaucracy. That says that because it is the simple option does not mean it is always the best one, because using all of your savings to buy a property you can leave you without liquidity. And in my opinion, this is one of the biggest mistakes someone can make. Not only because buying a property in Spain involves more costs than just the purchase price, but also because once the property is broke, unexpected costs can always go up. Renovation, furniture, community fees, taxes, maintenance, and if you are left without a financial cushion, what looks like a very comfortable purchase can start to create financial stress. So buying with savings can be a good option if you have plenty of capital, you want simplicity, you want to negotiate from a stronger position, and you do not mind tying up a significant part of your money. But if buying means practically emptying your bank account, I would think twice. The second option is to finance the purchase with a mortgage in Spain. This is usually the most common route for many foreign buyers, especially when they want to keep part of their savings available. There is something important you need to know here. Spanish banks do not normally offer 100% financing to non-residents. What is most common is financing up to around 70% of the purchase price or the valuation, usually whichever is lower. That means that you, as the buyer, will need to contribute a significant amount of your own funds. In practice, this often means having approximately a 30% deposit plus around an additional 10% for purchase costs, especially taxes and related expenses. So in many cases, you need to have around 40% of the property price available. So what's the advantage of taking out a mortgage in Spain? The main one is very clear. You do not have to fully deplete your savings. You can buy the property, keep liquidity, retain part of your savings for emergencies or other investments, and spread the cost over time. Also, if your income is solid and you fit well within the bank's lending criteria, it can be a very reasonable way to buy without making the full financial effort all at once. There is another advantage that many people do not fully appreciate at first. If you are buying a property in Spain and your income comes from another country, a Spanish mortgage is specially designed for this type of operation. In other words, the Spanish bank is assessing the property in Spain, the warranty in Spain, and formalizing everything within the same legal framework as the property itself. That brings a lot of currency to the transaction. What is the downside? As a non-resident, the bank will usually be more demanding. They will ask you to prove your income, job stability, savings, bank movements, personal documentation, and sometimes professional track record if you are self-employed. In general, they will review your profile very carefully. And on the top of that, conditions for non-residents are not usually as favorable as they are for tax residents in Spain. Even so, it is still often a very good option, especially if you have savings but you prefer not to spend all your capital at once. The third option is to use financing in your home country instead of applying for a mortgage in Spain. And here we are entering an area that can be interesting, but one that needs to be analyzed very carefully. Why would someone choose this option? For several reasons. First, because they may have easier access to credit in their home country. Second, because the regular bank may offer better conditions. And third, because some buyers prefer arranging financing in an environment that they already know well, in their own language, with a bank they already trust, and with products they already understand. On paper, that can sound appealing, but there is a very important point to understand. It is not the same thing to have a mortgage secured against the property you are buying in Spain as it is to have a personal loan or financial secured against another asset in your home country. Because if the bank in your country is not taking the Spanish property itself as the security, then in many cases what they are offering is not really comparable to a Spanish mortgage, but a different type of loan. And that may involve higher interest rates, shorter repayment terms, higher monthly installment, and in some cases more strain on your finances. It may also happen that you use an existing property in your home country as collateral. In that case, yes, you may be able to raise the funds to buy in Spain, but you are shifting the risk onto another asset you already own. So you are not avoiding financing, you are simply structuring it in a different way. Can it make sense? Yes, absolutely. For example, if you can get a much better rate in your home country, if the repayment suits you better, if the process is much easier, or if you want to buy quickly in Spain and you already have financing almost fully arranged there. But you should not automatically assume that financing in your home country is better. Sometimes it seems more common at first, but in practice, it can be more expensive or less flexible. So what is usually the best option? This is the important part. Buying with savings is usually better if you have plenty of available capital, you want a fast transaction, you value simplicity, and after the purchase you will still have a sufficient financial cushion. A Spanish mortgage is usually better if you want to preserve liquidity, you fit the bank's lending profile well, you already have part of the funds needed, and you want financing that is directly linked to the property purchase in Spain. A loan in your home country may be better if the bank there offers clearly better conditions, the process is easier for you, or you have a very specific financial structure that makes financing outside Spain more efficient. But in most cases, the smartest question is not simply, where can I borrow the money? The real question is, which option leaves me in a better financial position after I buy? Because buying a property is not just about completing the transaction, it is about the position you are left in afterwards. How much liquidity you still have, what your monthly payment look like, what level of risk you are taking on, and how much peace of mind you keep. The mistake I see most often is this. People focus only on whether the bank will approve the mortgage or not, and they do not look at the full picture. Some buyers can afford to pay cash, but they leave themselves without liquidity. Others want a mortgage in Spain, but they do not actually have enough savings for the deposit and purchase cost. And others manage to get financing in their home country, but end up with repayments that are too high or are worse or extractor that they expected. That is why, before making a decision, you need to compare these three things carefully. How much money are you going to tie up? How much the financial is really going to cost you? And what your financial situation will look like after the purchase. Because buying well is not just about securing the property, it is about buying in a suitable way. So, to sum up, if you have a lot of savings and want simplicity, buying in cash can be a good option. If you want a more balanced operation and prefer to preserve liquidity, a standing mortgage is often a very reasonable solution for non-residents. And if you have access to clearly better financing in your home country, it may be worth considering, but only after comparing it very carefully with the Spanish option. What matters is not choosing the option that feels easy at the beginning. What matters is choosing the one that suits you best in the medium and long term. If you are thinking about buying in Spain and you are not sure which option will suit you best, leave me a comment below. And if you want, in another video I can also explain how much money a non-resident really needs to buy a property in Spain using real examples.